Check, check, check. Hey, everybody. So, sorry, Mark's got me busy earlier on in the day. So let's take a look and let's talk about some stuff. Um, this is a day I've kind of been warning about a little bit. Members know that, and I think it's finally happening. Some of my fears are playing out. We've seen some credit contagion problems, and I think it's worth talking about because there are a few things that could lead to this continuing to be a difficult market. Now we know all the positives. AI is going to be an incredible productivity tool. We're going to really see it make a big difference for many, many companies. But we're also going to see that this is the ultimate age of disruption, which I've called it for 8, 9 months. And I said, listen, at some point we're going to get to a stage where analysts aren't going to know where to value things, and we're going to start having very real threats to moats and some of them that have been around for decades and decades. So when I say moat, that is a very solid position in your industry where it's very difficult for competitors to come in and mow your lawn. Well, this is the world is changing very, very quickly with the agentic movement that started with OpenClaw, which I called the Netscape of AI moments, because it's sort of the moment where we take something that everybody thought of as kind of a really powerful chatbot, and it's amazing and it'll do these things, it'll create pictures. This is the moment where it all kind of goes into creating actual assistance for you. Really, the ability to create multiple agents to do different things in your company or just even in your personal life is pretty amazing. So this morning we're getting a little bit of a push from Iran, but we're going to talk about how all it really took, and I said this in recent videos. I said, listen, it's not, when we talk about short gamma, which we'll talk about in a moment, that's not in itself a problem. The problem is something that gets us into a stage of market and movement where we start to get the accelerant starting to pick up, right? The accelerant that's going to kind of push that snowball down the hill. And then once the snowball starts rolling, it's difficult to stop, and starts picking up debris and bits and pieces of the market and industry and all these things. That's when things change, and it isn't because of fundamentals. It's not because of cash flow. It's not because of AI is not a great thing that's going to help so many companies. It's because of the structure of this market, as we've taken on so much more derivatives exposure. And that just becomes a part of it. In past videos, I've talked about volatility targeting, CTA flows, synthetic gamma from the levered ETFs and things like that, right? This all contributes now. This is a much, much bigger world than it ever was even 10 or 15 years ago. And it now has a big influence on things. So I've been also talking about watch that XLF chart, watch that HYG chart. Let's take a look here. We've got the XLF. We can see this chart here. We had this was a line that I drew out a little while ago. And so we popped down through there, and we've rallied back up almost into this range here, but we rejected at this spot here, this basically the breakdown spot. And now we've made new lows, right? So even though we're rallying today, we can see that we've now made a slightly lower high, we've made a slightly lower low. And I think some of this is going to be related to some of the credit issues we talked about, Blue Owl, and some of those issues related to lending, right? Remember weeks ago, I said, listen, there's quite a reasonable chance that a lot of lending has gone into software. And so from the work that I've done, I've come to realize, whether this is completely accurate or not, but we have about a $1.5 trillion of lending to software software companies, right? So in that space, we have a lot of software companies that were given the ability to grow in the private space, and now the world has really changed, right? So it's unquestionable that in the last couple of months, with OpenClaw and agentic powers and the possibility of agentic swarms starting to do everything, I think the world has really, really changed. And so from the standpoint of non-physical types of things, which software very much is, anybody who's been given funding, there's a problem there potentially, because many of these companies that were unicorns that might have been worth a few billion or a billion or whatever it is, some of those may be worth zero now. And software, the issue there is that you don't have any assets really, right? So if you go after a company because they're in trouble now, well, there's really nothing to liquidate, right? There's very, very little there. So these are companies that in many cases aren't making any money. They have no physical anything. And so these end up being total losses. And so we're starting to see that nervousness play out. I also mentioned to watch the HYG chart. So I bought a whole bunch of puts up in here. One of our members actually kind of highlighted it and sort of put it back on my radar. So great on him. That's one of the great things about the community is we get these amazing, smart people just throwing out ideas. I had been creating other kinds of negative expressions in the market. And here we go. We've had a nice big sell-off. And could it get worse? Well, yeah, I think it could get worse because I think the underlying reasons for the software sell-off aren't necessarily going anywhere. So think of a really big sell-off as being a highly correlated event. What that means is everything just kind of gets dumped, right? You know the old expression, the baby out with the bathwater. So of course, at first, when there's a fear, which is exactly what happened when IGV was up 103, 105, and I said, I don't understand why this thing isn't down more. And sure enough, it started to sink in, and they sold everything. Indiscriminate selling. It doesn't matter what kind of software company you are, whether you have a more solid moat than somebody else. They just sold everything. So now they're starting to pick apart that's the next logical stage after a big sell-off. Start to figure out, okay, well, who has a good chance of surviving? And that really is the concept that you have to get your head around here, is that word survivability is very important. And I see people talking about cash flows, and this company has these great cash flows. It doesn't matter. Where are they going to be 4 or 5 years from now? That is really the issue that people are worried about. So the world has drastically changed in a very binary way for some of these companies, and some of them may figure it out, right? I'm not saying these companies are necessarily going to go down, but what we can definitely say is that we do not have a good level of visibility for many of them. I don't know where Adobe is going to be in 10 years from now, let alone, 20 years from now. So, 3 years from now, I don't know what Adobe is going to be doing. They're going to be around. I'm sure Adobe is going to be around. But can we look at their future possible monetization of their products? Can we look at that in the same way and relate that to how they've been making money so far? It may change very, very, very much, right? So we just don't know. And that's why people have moved out of those types of things and into the physical economy. But as I've been saying to members and in notes, I've said, listen, at some point, if the selling gets a little bit more indiscriminate in a broader sense, right? So I've been saying for about a month, listen, there's only so much disruption the market can take. Disruption, that sort of feeling that, oh my goodness, AI is starting to do things that maybe we expected at some point, but it's happening much, much more quickly, right? It's happening more quickly. So what I think has happened is I expected worries to show up, but maybe at the end of this year. So when I started to talk about this with mentoring students in the middle of last year, I said, I think we're going to get a really nice run. And then probably at the end of 26, we're going to start to get worried about how quickly things are getting disrupted, because maybe 100 of the S&P 500 companies don't exist in 10 years. It's quite possible, really. It really is in this new paradigm. And so I think that has been pushed forward. I did not expect the agentic AI. I said this was going to be the year of agentic AI, but I did not realize that the OpenClaw door has been opened, and it is absolutely going to start moving very, very quickly. This is now the what do they call it? The sort of recursive, this sort of agents working with agents. That's a very big thing, right? What's the big bottleneck for many things? It's humans, right? We have to sleep, we have to eat, we have only so much brain power that we can apply. Some people have more, some people have less. Humans are really the bottleneck. So when you have a human as a sort of almost like a sort of a toll booth, in a sense, where you have to kind of go through there to kind of make sure things work. Well, that's the way the world has typically worked, right? At some point in many processes, the human has been there to basically say, okay, well, this makes sense. Okay, let's go in this direction, or let's not go in that direction. What happens when the agents, when you start to create these agentic swarms of like hundreds, thousands, millions of agents just starting to do things on their own? Well, they don't have to sleep. They don't have to eat. There's almost no downtime in theory. So this is where things start to accelerate at a rate that we just almost can't comprehend, because in our minds as humans, we understand mortality. We understand there's a start and a finish. There's only so much in terms of resources that are available to us. And that's just simply almost not the case for agentic. Now, do we come up against real bottlenecks in the physical world that start to limit how much compute people can actually consume, right? So I think this is a world of almost infinite compute demands. Can we satisfy that infinite compute? Not really, because there's a limitation to physical, right? We think of the intranet and everything as in the cloud, and it's very physical. It's copper, it's photonics now, which is one of those areas I think still looks very interesting. It's data centers, it's chips, it's stuff, it's cement and real stuff, right? So there is a limitation to this idea that we can have just like 100 trillion agents and infinite compute and just things kind of going berserk. Now, that probably won't be a limitation at some point in, I don't know, 50, 100 years from now. But for now, there probably is some sort of physical limitation to what can happen. We're already seeing some sort of blackouts, right? Like, think about the electrical grid is not made for what's about to happen. It's not, right? And that's why we're starting to push into the LITEs, and GLW's been doing well, and COHR. These are important things, important technologies. We have to figure out how to get data moving more quickly, and light speed is pretty darn quick. So these are going to be important things. So let's get back to some of the things we want to talk about. So here is one of the problems as we accelerate to the downside. Actually, I wanted to talk about this quickly. So here's the gamma profile. I got this from Spot Gamma. And we can see here, we're in this sort of world where I've been talking just a little bit about it, how we're almost on a hump, right? So think of this hump as positive gamma. So that may be a little bit of a new concept to some of you. I do have some videos that you can watch that explains this very well. I remember somebody saying, wow, that's never been explained so well to me. So if you want, put it down in the comment, just say, hey, what's the link to that video? And I'll try to get that out to you, or Natasha will, or somebody on the team. But basically, when there's positive gamma, that is conducive to less volatility, right? Where does that come from? Well, it comes from cover call funds selling tons and tons of cover calls, and just kind of saddling market makers with a whole bunch of long gamma, as we call it, long option premium, which is what I did for 15 years, trading this gamma profile type stuff. And so as we're up here, we don't move, but we're sitting on a hump, which is, it's not always the shape, but you can see here how there's a lot of positive gamma, which means market makers are selling on the way up. They sell futures, they sell stock on the way up, and they buy it on the way down. What does that do? That stabilizes things, right? Things can't run up too quickly. Things can't run down too quickly. There's a supportive nature to the downside of market makers hedging out those deltas, right? That's what they're basically delta gamma hedging. So we won't get into the math of it because the videos will explain that. But what happens is below a certain point, we get into a negative gamma reality. And what that means is you have a whole bunch of, basically the dealers are short puts. What are people doing? They're selling calls, they're buying puts. From the dealer's perspective, that means they're long calls and they're short puts. That's kind of, you can't generalize, but that is a sort of very typical kind of framework you can think of from a dealer perspective, is that what clients are doing, the dealers are doing the opposite side. So once we get down to where the dealers have sold puts to either a JPM caller fund or whoever else is buying puts, well, now they're going to be short those positions, right? So now, instead of being able to be supportive by buying futures or stock on the way down, now you actually have to sell into sell-offs. So I don't want to spend a ton of time on this, but basically we're on this hump in that we're positive here, but we're negative to the upside, and we're negative, quite negative to the downside. And what that means is that can act as an accelerant. So remember what I said earlier. I said, it's not about profit margins. It's not about good company, bad company. It's about structure. These things are more important than they ever were, right? When, years and years ago, when I started off as a market maker, this was small potatoes. This was a small world. This has become a large world. And add to this, you have the levered ETFs, the inverse ETFs. The levered ones are the ones that are more important. The 2x this, 3x that, whatever. Those also have a synthetic negative gamma aspect to them where they need to sell on the way down. So when semiconductors have a horrible day, they need to rebalance the basket and they need to sell into that weakness. So let's not go on too much about that, but there is an ugly, as we say down here, there's an ugly gamma profile down around where we are. So we're now no longer in the cradle of support that we were in, and we're riding down one side. Now, to the upside, we also have that. So that's why to the upside, if we really got some momentum, the upside, we could actually get the opposite, where we accelerate to the upside. But we're not there, right? The market, because of perhaps the instability, the disruption, and certainly because of Iran, that was not supposed to, be a prolonged kind of conflict. And it looks like it may be. I don't know. I have my doubts a little bit, but we'll see if that continues to be a problem. Which of course has all the other tangential effects of, okay, maybe it pushes up inflation a little bit because oil gets more expensive. You're limiting, shipping routes, and you're sort of making the Strait of Hormuz, where you have a lot of kind of movement, and then suddenly insurance companies are saying, no, you can't go through there. So there are things that can contribute to supply chain problems, to inflationary effects. Over time, I think inflation is going to be fleeting. So I'm not super, super worried about that. I think the bigger problem is going to be the employment side, which the Fed will eventually focus more on. But for now, we live in a little microcosm of a world that is being kind of pushed along by Iran. And we have to live in that world until that gets either sorted out or the market decides that it's not a problem anymore, which is sometimes the way things work out, right? Look, there's been a war in Ukraine for 4 years. Nobody talks about it, right? So eventually, either things get sorted out, or the market just kind of moves on and says, well, here's, the glass is half full at some point. But for now, it's something to watch. And so based on that, I wanted to show you one of the things that I watch, as I mentioned in the Gamma chat, is the CTA. So these are the commodity trading advisor type funds. Now, they're not necessarily commodities. They're called that. But basically, it's any kind of sort of strategy, a kind of an algorithmic type strategy where, it could be like almost like a risk parity type thing. These are separated out here, but these are all kind of in a similar basket of, when there's big selling, these things start to sell as well. And as the selling gets worse, they have to sell more and more and more to de-lever, to de-risk. And the same goes to the upside, right? So the vol targeting, these funds are really kind of, a lot of them have been sort of all in, like basically fully allocated, which means there's not as much to keep pushing markets up, where between 6,000 and 6,800, it was very much, many of these strategies were not fully all in. So that remained as a sort of nice tailwind for markets, kept sort of keeping the market bid and pushing things up. Now they have only one way to go, in a sense, which is in down markets, they're going to be selling. So here's a massive amount of selling that needs to happen in markets if we continue to see weakness, right? So remember, structural. Is this somebody saying, well, I don't like NVIDIA, I don't like the prospects for NVIDIA? No, NVIDIA's numbers were fantastic. NVIDIA is doing incredibly well. I'll show you that in a moment. Look right here. NVIDIA is doing incredibly well. Look, earnings per share, there's nothing wrong going on here, but the semiconductors have stalled out. They are not in favor. They're in that world of technology, which is the hotbed of disruption right now. Do we really know? I mean, the physical part of the build out, I feel better about. I think that semiconductors are probably an okay place to be. Software is the complete opposite, is the opposite of physical. And really, that's kind of where the US has been so strong over the years, right? It's been this sort of, and it's been rewarded for that. It's been, low asset, very small asset companies very digital, very highly profitable companies. Now the opposite has become true very quickly, which is now it's people want real stuff, right? They can't trust the digital world of, low asset kind of world, because they want real things that they can drop on their toe, things that they can eat, things that they can drink, things that they can, literally put their fingers on and feel. That's not the software world. And with agentic AI, that entire world of non-physical and digital based world is under threat because of all the possibilities. You can build a program in literally like 30 seconds. So the world has completely changed in that asset light part of things, where things have been very, very positive for the better part of 20 years. And so to think that that's going to change and revert back to asset light being fantastic, I think is a mistake. I think if you think that this is necessarily going to suddenly be amazing, that doesn't mean some companies can't figure this out, and maybe Salesforce figures it out, because enterprise isn't going to just kind of switch to some made in the basement kind of program. And maybe Salesforce figures it out and gives them a lot of value based on AI, right? They're going to use AI to try to keep their customers. Maybe they can't charge as much. We don't know how that's going to play out, but not everybody's going to go bankrupt. It's just a matter of asset light is no longer a powerful tailwind. And that's very impactful to the US economy versus the rest of the world. Why has the rest of the world been doing great? Well, they're not asset light. They have all the other stuff. They have real things. They have materials. They're much, much less asset light, which has been a headwind for them in some ways for years, because they haven't owned all these really wonderfully profitable things. So the world has literally flipped upside down. And that's why people are running into glass makers and copper companies and things like that, and cement companies, and you name it, anything you can relate to the build out and the increased build out, which is going to happen. We're going to be building out and retiling the world for years to come. And there's going to be very little that's going to slow down AI. But from the physical standpoint, because it's like electricity was just invented. Well, there's no stopping it. Good times, bad times. It's not cyclical. You are going to need to retrofit the world and create the infrastructure to host electricity, because it is a necessity, right? So AI and is going to be a necessity, right? So this isn't going to really slow down very much at any points, unless we go into some global, recession or global depression. This isn't really going to slow down. So I think that's what makes the US market very challenging over the next couple of years, is it's kind of not in the right places anymore after so many years of being the only game in town, in a sense. And I think that's going to impact their profits as well. And just to add to that, if I want to close this loop here, is that now they're spending more than ever, right? Asset light Mag 7 stocks are now spending money and CapEx heavy and just, and I think that could be a problem, because this is really a world where compute costs are going to go to zero, right? Somebody, I can't remember his name the other day, but he was saying, basically, it's about $10 for whatever it is, a million tokens right now, to sort of process a million tokens of compute. That's going to go down to 10 cents. And so the cost of knowledge is going to go to almost zero. So if you're spending all this money, you'd better be figuring out, you're not going to be making money selling 10-cent AI to people, or 1 cent AI, right? Like, they're always going to have people who are going to spend probably $5,000 a month on an incredible amount of compute demand. So I'm not saying that business is dead, but the business of selling AI is not going to be a good one. It's the business of using AI to create ecosystems that people rely on, that deliver value to them. That's where the value is, right? So that's where maybe a Google has a big advantage, because it's created this ecosystem that is just a part of our lives in so many ways. Now, agentic will also threaten parts of those, right? You can make your own browser. I mean, you can literally make your own browser. So what does that mean for Chrome? So I think that's part of the headwind for Mag 7 and some of these stocks that we've thought of as infallible over the last few years. And even up to recently, I thought, man, toll booth companies, they're going to, a couple of them are in great shape. I don't think anybody is immune to what is happening and is about to happen. And that just makes tech even more difficult. It's a market. Things are going to trade. They're going to rally. They're going to sell off. There's going to be massive rallies. Maybe software goes on for a massive rally. But I think you have to keep in mind the longer term repercussions of what's happening out there. Massive divergence between commodities, 10-year break-evens. I mean, something's got to give, right? Commodities have to come down, or inflation has to kind of react. Like, this is just sort of a strange market where we're seeing a big sort of divergence in a lot of ways out there. Let's take a look at, what was the other one I wanted to look at? Actually, there was something. Oh, yeah. Here it is. Okay, so I wanted to show you. Here we go here. So this is kind of interesting. So look at Goldman Sachs banking market. So here is your call strike funded with a 20% out of the money put. So think of this as a risk reversal trade. So this is measuring. Let me make this a little bit bigger so you can see this. How about 200%? What is that going to mean? Okay. That's okay. There we go. So this is measuring the cost of the 20% out of the money put to buy an out of the money call. That basically the put, selling the put fully funds, just about exactly funds the upside call, right? So you're selling a put to purchase that 20% out of the money put to purchase an upside call that's the exact same cost. So they say it's costless, right? So it doesn't cost you anything because you're taking in $5 for selling the put and you're spending $5 on a call, right? So what does that create? That creates upside, right? You're selling that juicy downside skew, which is massive at this point. The skew is like off the charts. Look at this 1 month put to call skew is huge. We haven't seen this since 2022, right? Since like before the bear market, basically. So this was a very disruptive sort of environment because of COVID, because of technology's role in it, and because of everything going on in the world. We had this sort of weird kind of market where skew was soaring, meaning puts were soaring, and then we went into a complete sleepy type skew market here. And now we're back to puts being very expensive. So what does that mean? Well, you can sell the expensive put and buy the relatively cheap call. And that's what this is measuring, right? So this is at the lowest cost, right, that we've seen. Basically, the puts are so expensive versus the calls that this is about as cheap as this spread gets, right? So this is giving you that really nice upside potential. So the trade right here from a volatility standpoint is actually selling the put to fund that upside. But I haven't been pushing that. I've been noting it, but I haven't been pushing it. And part of this is that interest in mag calls is all at multi-year lows, right? So they've basically all but given up on the mag 7, which is maybe just a slight positive, right? That combined with this means that you don't want to get too crazy bearish on mag, in a sense, on the market, in a sense, because the risk reward, right or wrong, if you decide on direction, is that the upside is cheap compared to the downside, and people have really given up on the mag. So from that perspective, getting massively bearish on it isn't a great idea. But having said that, I'm bearish on some parts of it, right? Like I'm short Microsoft, and I have some structures in there. I'm not short it stock wise, but I've used option structures to create short opportunities, which I think is where potentially, if we break down, could be a big problem for the market. So we can see the market was down. SPY was down about 15 at one point. QQQ maybe about the same thing, and we've rallied back here to that level about halfway. We still have a VIX above 24. So yesterday I was telling members, I said, even though the market's kind of at one point was doing fine, it was up on the day, the VIX was still in a concerned state. Why is that? Credit, right? So let's talk about some of the credit problems. Like here's KKR, Blue Owl. Do I have Blue Owl here? What's the symbol for that thing again? Blue Owl. I can't get it. Blue Owl. I don't have it. But Blue Owl, private credit, heavy exposure to pretty high exposure to software. And as I said earlier, that's the problem, right? If you have, is that going to cause a little bit of a contagion? Because suddenly the world has changed so quickly that markets can handle gradual changes over time. But because things have happened so quickly, there may be a problem. We've seen some companies gate the funds, right? So you can't redeem if you're in private, if you're in one of these private funds where they've lent out to software makers. They've said no, you can't get your money out. Now I'm starting to hear that some people are able to get some of their money out now. So they're sort of slowly starting to kind of liquidate the underlying assets or do whatever it is they need to do in order to give money back to people who are getting nervous and want out. They're not going to get a great price for it, but they're getting out. So let's go through some of these stocks here. Google, I think, is probably not a bad one. If you have to pick a mag, it's probably one of the better ones here. Now, having said that, we could get down to about 290. Microsoft, I don't like it. I have to say it's starting to look interesting here. I don't know if this is screaming short me. I think Micron, very surprisingly, look at this, down to this spot here. So let's activate that. Take a look at what that looks like if we get this out here. Kind of a almost like a little perfect touch here. So I wouldn't say it's in massive amounts of trouble, and I think that memory area is still a big problem. Big shortages, amazing pricing power. I was in a computer store the other day. Memory's quadrupled, right? So these guys are doing very, very well. Let's look at the hard drive guys. So yeah, the hard drive guys. This one was interesting. I noticed the Seagate yesterday. It's sort of had the weakest relative performance. So we've had this got to 450 down to about 350, but these things have had just amazing runs, right? So the memory, the storage area, what are you going to need more of? You're going to need more memory. You're going to need massive amounts of storage. I said that 7-8 months ago on my special situations show. I said we're just going to be creating more data than we can imagine, and so that there's you got to do something with that. Now at the time I also said, well, I think Snow is a great company to consider because someone's got to organize all that data. And that thing, we did some great trades in there, but it has not done very well up to this point. So even the data stocks, because they're considered either software or a kind of middle layer, right? A sort of think of platforms as a facilitator. They're software, but they're not software, but they bring people together to accomplish something. Well, agentic also potentially threatens those types of things. So Palantir has been acting okay, especially yesterday on the war in Iran, or the skirmish in Iran. Hopefully it doesn't turn into a full-on war. It jumped, right? Because it has that government exposure, and really what they do is amazing. It's just a very expensive stock. We tried to buy some call spreads yesterday in Leaps Trader, and we didn't get them. We didn't get filled because I was like, luckily, I just said, oh, I'm going to stick out an outside bid. Didn't get filled. We got filled this morning at a really good price. And one of the areas I wanted to mention, one thing, which is I'm starting to get a little bit interested. I run a service called Crypto Trader, but it's been very quiet, right? Because I figured it's just better to not mess with this stuff right now. But I think there's some interesting plays potentially in that stablecoin space. I believe this is a turning point for blockchain, for stablecoin, not necessarily for Bitcoin, although it'll probably participate, but in the utility side of things, right? That's where people have been focusing on. Where's the utility and stuff? Where can I actually make use of something that is in the digital world, right? That's where you're still going to derive some value. And Bitcoin doesn't do anything. I'm not saying it's not worth considering, but it doesn't do anything. But stablecoin does, right? So the ability for agents to kind of transact amongst themselves. I'm going to get more into that in another video, but I think that's kind of an interesting place. And we've seen one of the things that's done well has been Circle, right? It got down to $50, and now it's $100 very, very quickly because the stablecoin issuance it just continues to grow and grow and grow. And I don't think that that's a train that's going to stop going, right? I just think that's going to continue and continue. And I think that that digital transaction layer is going to happen one way or another. We don't exactly know how that's going to play out, but I suspect there's going to have to be some reputable, trust-based ecosystem, and there are a couple stocks I really like for that. So watch out for that video. That's about it. So another one that I've been light, I recommended to members at about $400. It went to 800 in the space of about a month. So happy to have helped folks out there. And COHR, which I said this is a bit of a lagger, around 220, 230, and here we are to 289. We got to 300 this morning. And what do you need for photonics? Get moving data. Well, you need glass. So look here, you've got Corning, which got down to 142 this morning. I think it's an interesting spot there. I'd like to see it kind of retrace maybe. I mean, it's gone from 95 to 160 in an awful hurry. And I love it. And I think these kinds of stocks probably do well for the remainder of the year, especially given the fact that I think tech is a difficult place to be. That's sort of pure tech. That doesn't mean this tech will do poorly. I think this tech can do well, or I should be looking more at Lumentum, Coherent. And I think there's some other areas that look interesting, right? Like Akamai. I mean, look here, a nice little move today because that plays into agentic AIs. I think Cloudflare plays into that as well. So they are starting to kind of pick apart some of the disaster that software has been and say, well, this is not as disruptable or disintermediated. And then I think power is still going to be a concern. So I think some of the power names, I've liked Cypher, I've liked Iron. I mean, there are some companies that are getting great contracts. Oklo, I believe in modular reactors. So I mean, they just couldn't care less about these things right now, but I think that's an interesting opportunity. So anyway, I hope you guys enjoyed this. Let me just see if there's anybody with a question. Let me see here. Let me see if there are any questions. Let me see here. Oh, this is YouTube Studio. I'll stop sharing there. And then I'm going to put this over here. And here we are. Okay, guys. So I hope doesn't look like any questions, but I hope you guys enjoyed that. And anybody who's watching it later, enjoy. And definitely, if you guys have any thoughts about anything, you can disagree with me. I love it because I want to know where my blind spots are. I have blind spots like everybody else. So pop it into the comments there. Let me know where you think I've got things right, where you think I haven't gotten things right. And we will see you guys next time. Thanks for coming.